I would say a combination of all these factors, first of all. Let's start from what happened in 2025. In 2025, for the first time in many, many years, non-US market outperformed the US. This was a very important change compared to what we experienced so far. That's why we see many investors starting to look at diversifying across region and countries outside the US. We think this trend will continue in 2026. What investors are searching for are growth story, and a good example would be the AI sector in China, or a story of fiscal and financial integration in Europe. That's the first factor. The second one is about valuation. As you know, US stocks are pretty expensive, so there are other markets which can provide more upside simply because they start from lower valuation. The third factor is FX and hedging. And this is something also very important. We expect the US dollar to continue to weaken in 2026, although not as much as in 2025. This means that investors will also look at countries and regions with currency which are expected to strengthen going forward. This is definitely the case for the euro, maybe the Japanese yen, and also I am in China, there are talks about eventually the Chinese RMB to strengthen more, which will definitely make the stock market in China more attractive. Well, first of all, there is a view that investors are not traditionally very good in pricing geopolitical risk. If you look at actually what happened in 2025, this might seem to be the case. We had a period of very strong geopolitical volatility, but we have a very good return across asset classes. I would say across all the regions as well. Say that, I think there is, as I mentioned already before, a recognition that there is a new geopolitical environment we are living in. And so investors are starting to adapt. First of all, we are seeing the search for macro hedge. The typical example is gold. Gold, which until a few years ago was considered sort of an asset class that you look at only in a residual way, now has become a key pillar of asset allocation in the sense that it provides hedge, for instance, against geopolitical risk or inflation or over macroeconomic risk. On the other hand, what we recommend to clients when we think about geopolitical risk, first of all, is about country concentration. We think it makes sense not to have a too high concentration to a single country. One good example would be the US equity market, which, as you know, has been growing very fast over the last few years. And as a result of this outperformance, has started to have a much larger weight in the global portfolio of investors compared to the actual weight of the US stock market as it was a few years ago. We are seeing this diversification away from that. But also as well, it is important liquidity. Liquidity is a very important factor for the majority of investors, and the liquidity is important because it allows you to move out and respond quickly to eventual geopolitical risk, like for instance conflict or war or any other sort of political fragmentation. So diversification is the rule of the game here. You need to be diversified across different asset classes, regions and countries. We think that we are just at the beginning of this diversification journey, which will continue in 2026 and beyond. From a geographical perspective, I just want to stress that we still have a positive view about the US equity market, but we just think that it makes sense to diversify a little bit more compared to the weight that currently the US equity market has in the portfolio of global investors. Within the advanced market economy, we think that Europe is attractive, largely because of valuation, although I think there is a question about whether Europe will be able to deliver in terms of reforms going forward. But still, we think that Europe will continue receiving inflows of capital from investors willing to diversify away from the US. We definitely like emerging markets, definitely for a question of valuation. Emerging market equity is still cheap compared to many advanced economies. And within emerging market, of course, Asia and China are our primary focus at the moment. Moving to asset classes, we believe that there is a scope for still generating good return in fixed income. It's true that we expect interest rate in the US to fall somewhat in the course of 2026, but they will still remain relatively high. So there are still good returns that you can generate, particularly if you move away from government bonds into spread products, corporate bonds, high yield, and emerging market debt. In terms of further diversification, alternative asset classes play a very important role. And here we see a role for assets which can provide hedging. And we are talking about, first of all, hedge fund, particularly macro hedge funds are very attractive in the current environment. But we also see the role being played by infrastructure and private lending and private loans. With regards to the latter, very important to note this is an asset class which has grown very fast in the last few years. There has been question during 2025, but we do not see any systemic issue concerning this asset class. Of course, you have to be very diligent in the selection of the manager where you invest your money.